We have to think about really reimagining the American dream in a way that allows for access to people.
Welcome to Housing Insiders, a podcast for those crazy people like us who believe that everyone should be and can be well housed.
That's right. Our guests are founders, builders, change makers, and regulators from Silicon Valley to DC, everywhere in between.
We're really proud to partner with Built Rewards to bring you these smart conversations. If you have an idea for a guest or a show, or have an interest in sponsoring an episode, email us at podcast@thehousinginsiders.com.
And if you like the show, please click like. Subscribing, following really helps us get this podcast out there and then make more podcasts for these topics. So Jonathan, since we call ourselves two housing wonks, I guess it's only appropriate that we've spent this week together at a housing policy conference in Washington, D.C.
Yeah, we sure lived up to our name this week. We had a lot of great conversations. I'm excited to share with our audience all the wonky things that we learned this week and also really nerd out on some housing policy with our fantastic guest. But before we introduce her, Jeremy, let's talk about some headlines.
One of the op-eds that came across the radar this week was from Professor Ed Glazer.
Yeah, that's right. He is claiming that one way to encourage zoning changes is for the federal government to withhold transportation dollars as an incentive to make people change their zoning policies.
Yeah, the way it sounded to me was, there's a carrot, right? Here's the money. The federal government wants to put more money into housing and wants to push it through channels that include states and municipalities. So his argument was, well, if you're going to do the carrot, there's got to be a stick.
And it seems like it could be a very effective one, given how much money people receive from the federal government on transportation. Although the one thing I worry about, per our conversation with Odetta in our first episode, is that transportation is also critical to a lot of other things. And so if states don't take transportation dollars and that gets worse, now we're two steps behind and we'll never catch up.
That's a great point. I think anytime you start mixing complex topics, you have this potential that it goes really wrong and you actually create more friction rather than less friction.
Yeah, so looking also at the headlines, there's another interesting lawsuit that came out of D.C. recently. I know, Jeremy, you've been paying attention to this one, so I'd love to hear your thoughts. But a very common thing that's happened in the past, JVs between realtors and title insurance companies have come under scrutiny in D.C. specifically. Any thoughts on what we're seeing in that case?
So the D.C. Attorney General brought a lawsuit against 3 title companies in particular for this issue. What you would normally expect to see, and what you and I expected to see when we opened the article, was a RESPA violation, where you can't actually have kickbacks or other types of benefits in exchange for the referrals of a settlement service. But in this case, that wasn't it. It was that in D.C., joint ventures, which are an exception everywhere else under RESPA, does not exist as an exception in D.C., and so therefore it was a violation.
We like to do things differently here in DC for sure. But, you know, one thing that we're seeing in the market, though, is a lot more joint ventures between realtors and title agents. I didn't really understand this sort of this kind of relationship, but when you're working with your realtor and they say, hey, you should close at this title agency, they're making some money off of that.
Yeah, this is an everything old is new again type of category for me. There has always been the allowance of joint ventures where a real estate company could own a title company and they could make a rev share on those types of transactions that you just described. The reason it's coming back around now, with all of the scrutiny around real estate fees and commissions, a lot of people are thinking, well, I can lower my commission or change my commission structure if I have other sources of revenue, title being the most obvious.
So it's very odd to me that when I'm paying my title insurance policy, I'm actually paying my realtor again.
In some ways. The third thing we wanted to talk about here at the outset was a change that's coming in October, and it affects everybody's ability to pay their bills, right?
Yeah, I've been watching consumer credit lately because we are now at debt levels that exceeded pre-pandemic levels. We dropped during the pandemic because of a lot of the stimulus dollars, but now we're back up. And so anything that could negatively impact credit scores is something that's going to be a big concern for the industry. What we're seeing right now is that the student loan mispayments were not being reported to the credit bureaus. They resumed in October 2023, but starting in October 2024, next month, if you are not paying your student loans, you will now be marked as delinquent in your credit score. And so, just to put some numbers on this, right, $1.7 trillion of student debt out there, 43 million Americans have student loans. The average amount of their student loans is $33,000. And right now, 16% of student loans are not being paid. And 7% of those with bachelor degrees who have actually completed their degree are not paying their student loans. So this resumption of negatively impacting your credit for not paying your student loans, it's going to hit credit scores pretty hard.
Yeah, so this is going to be interesting where we find out how much it hurts when you are in that category of people who isn't or haven't paid up. But also, it's going to increase, just the way credit scores work, it'll increase those that did, right? Once again, if it's the K-shaped outcome where the haves keep going up and the have-nots get hurt even more.
Absolutely. One recommendation for those in the industry is to take a look at a couple of companies. And I know, Jeremy, you and I have both talked to in the past, Summer and Savvy. These are two organizations that will help consumers identify what student loans they have out there. No surprise, a lot of people don't even know what they owe. But then also identify whether or not they qualify for one of the federal programs to reduce their student loans. So those people that are struggling to pay their student loans, in a lot of cases, they don't actually have to. They just need to simply file and they can get a reduction on their student loans and they don't have to be delinquent. So partnering with these organizations is a great idea for those in the mortgage industry, the housing industry in general.
Yeah, you could be leaving money on the table and not even realize that some of these things go unclaimed. And Summer and Savvy are two engines that kind of help you find out that you have something to take advantage of.
Exactly.
John, today our guest is Marisa Calderon, the CEO and president of Prosperity Now. Prosperity Now is a nationwide organization headquartered in Washington, D.C., fighting to make the economy work for everyone.
Marisa knows a thing or two about housing. Prior to this role, she served as the executive director of the NCRC Community Development Fund and leadership roles at NAHREP, the National Association of Hispanic Real Estate Professionals. Marisa, welcome.
Yeah, thanks so much for having me.
So one of the things we wanted to talk about right off the bat was this concept of prosperity. And wealth creation has always meant homeownership. It's one of the reasons this podcast exists, and it's one of the things we talk about a lot. I guess the question for you is that still true?
I think for some people it is. And for others, they don't view themselves as having an on-ramp into homeownership in terms of owning an entire asset. And so we have to think about really reimagining the American dream in a way that allows for access to people that don't imagine themselves or aren't capable of owning an entire asset to just be part of that process.
I mean, just what are some obvious other ways that people, again, I don't know if it's right to equate prosperity with wealth directly or income or something else, but wealth seems like the most obvious thing. And what are other ways that people build wealth today outside of homeownership?
Owned assets in general, right? So any kind of owned asset is a pathway to prosperity from my perspective. As well as, at least for us, we think about three things: income building, and asset preservation. Because prosperity means that you control more of what you have, as well as you can build on what you have to make more so that you can have more.
Yep. I was just looking at the stats. I think homeowners have 40% more wealth than renters. So it certainly seems like historically that's been the way that people have really gotten ahead from a wealth perspective. You think that's going to change?
I think in this country it has to change because there's not enough housing available to make that a realistic opportunity for some folks. And there are a lot of other potential on-ramps in terms of collaborative ownership of different kinds of assets, as well as, most folks that don't own a home don't also participate in things like purchasing stock or necessarily having a healthy 401k. So being able to control more assets of some kind allows you to live a self-determined future. And prosperity for you might mean being a millionaire. For someone else, it might mean just being able to feed your family and sit on your sofa and watch television together and be able to afford to be able to do those things.
I think one of the things that comes up when you think about the message from the establishment, from the status quo, it's when you can't break in, it's always work harder, wait longer. And what I'm hearing and what I heard at the summit was, first of all, you just said it, it's not going to work for everyone. But then also, we have actually seen platforms, technologies, and other ideas break that down. It doesn't have to be one size fits all for everyone.
It really doesn't. And young people today, and when I say young people, I mean like young millennials and younger, don't necessarily want to own an entire house. They just want an entry point to own something. They want to own a piece of something. And collaborative ownership of homes, of businesses, those are things that we need to figure out as an industry, because the current systems and structures don't necessarily lend themselves fluidly to that. But that's increasingly more of what younger people want.
Jeremy and I are gonna go off on this collaborative ownership of homes, because that's something that we get very excited about. We think it's a really interesting trend. But before that, I want to take a quick detour, because owning businesses is something that is super important. And you mentioned for some people, prosperity is making $1 million, and like a lot of the tech entrepreneurs, a lot of our listeners who are sort of tech founders, like that's the goal, that great exit. But a lot of small businesses aren't like those kind of companies. They're basic small business, but they create real ownership opportunities. Can you just give us a sense of what the small business landscape looks like?
Well, from a small business perspective, I'm actually seeing some interesting things happening in Atlanta that are around collaborative ownership of businesses and business models. There's a group in Atlanta that is actually beginning to do like a co-op model that includes CPAs, attorneys, other professionals that are part of a business landscape, so that you as a small business can purchase services from them. And they, as a small business and these different professionals, can begin to provide their services to small businesses, but they don't have to establish a CPA firm, an attorney firm. They can be one collective firm and have shares of the business. And it's a more accessible way of actually establishing your business.
That's awesome. I hope they're really successful, so that when they show up to get a mortgage on their new home, the mortgage underwriter is like, "What the fuck is this? Like, how do I underwrite this nonsense?" But I think to that point, like those kind of models in small business and self-employed, mortgage underwriters, they're going to need to really catch up quickly to these new forms of ownership.
Yeah. I mean, I think that is the trick, really. Like from a housing perspective, owning a home relies on you having a W-2 in most cases. And increasingly, that is just not how people earn their income. And I mean, if we think about the impacts of AI and technology and how work is changing, more and more people want to earn their income in different ways. And the housing industry has to catch up.
We had our eyes open today just talking about the entrepreneurship data. We hadn't looked at it. We looked at it today. There has been a tremendous spike in applications for new businesses, small businesses since 2020. So we're actually seeing that the trend you just described is reflected in things like net new starts for small businesses.
And increasingly for women, for communities of color, for communities that don't necessarily have a huge amount of owned assets, but they're providing a solid business plan, services and resources and products that are necessary and desired. And so there has to be space for that as well.
Yeah, I mean, I love this concept of how do you get an on-ramp to ownership? That can mean a business. I got equity in a collaborative. I got equity in my business or my idea, or in home equity, which is, the traditional concept, but in a new way. So hacking, house hacking that you mentioned, but then also, ownership hacking.
Absolutely. The house hacking thing is so fun. And I know Nestment made a really cool announcement, Nestment, the co-ownership platform, talking about their NestGen accelerator program for homeowners. Just really incredible seeing those models. And it's amazing that Prosperity Now sort of embraces that, shares it out with an audience that's really receptive to those kind of house hacking strategies.
Yeah, I mean, I think that the reason that we're aligned with that is because, yes, we acknowledge that the systems are not built for everyone to prosper, but we could like go in a corner and cry about it, or we could do something. We can like pave a new path and actually figure out how to make things work for us.
So I want to pick up on the making things work for everyone. One of the things we wanted to ask you about was you've got these big concepts we just talked about. They drive a lot of emotional decisions and financial decisions, but programming is important. The organizations that make this happen on the street in Atlanta for those accountants, lawyers, and small business owners, how does it work that Prosperity Now is able to support like the entire ecosystem from what you see down to the street level?
I mean, well, we have a really large and growing network. So our space is especially not to try and take market share from those that do work that's closer to community and direct service. Our purpose is to really engage with that network to make sure that we're either amplifying their work or that we're aggregating capital and distributing capital so that they can do their good work. We feel like part of our vantage point as a national organization is being able to identify the friction points that cause for some kind of hiccup or speed bump in communities to be able to actually access capital or to become homeowners, and then to solve for that so that those that are closer to community can do the work that is of community.
Give us a sense of how that works, right? So you've got a lot of people that can write big checks, but they're too big of an organization to get on the ground to local individual organizations. So they rely, if I'm understanding it correctly, on organizations like you to sort of take that money and distribute it. What does that look like up front, up close?
I'll give you a very specific example with a green business accelerator that we're working on. So the climate economy is real, it's here, and we have experience from the last PPP that capital didn't make it to the communities that it should have made it to. And so we want to make sure there's not a repeat of that, because really the reason that happened is because the infrastructure to make that happen fluidly didn't exist. So seeing that that's the case, we have worked in several different communities, and we're working with CDFIs to ensure that they have the information and resources they need to identify what the climate economy opportunities are in their region, and that they are prepared to engage with small business clients that they work with, so that once they actually are prepared, they have knowledge, that when they get capital, they can engage small businesses and give them capital and get them plugged into the climate economy. Maybe solar is right for your area, maybe heat pumps are right in someone else's area. And if there aren't the contractors and businesses positioned to do that kind of work, we want to make sure those CDFIs in particular have the knowledge and resources to get their clients positioned to do that work.
So let's talk CDFIs for a second. So it's a community development financial institution, been around since the early 90s, created by law under Treasury. You're able to fund and support them. Infrastructure, technology, like you said, capital markets, liquidity is coming. Can you talk about your experience with CDFIs and what you see happening in that section of this problem statement?
Yeah, well, I ran a CDFI before coming to Prosperity Now. And so that gave me, I would say, a firsthand experience of not just running one, but of what ecosystem things are missing, or what creates hiccups in me being able as a CDFI leader to get capital. And what's missing actually is a capital market structure, because the CDFI industry back in 94, when that happened, was created with an understanding that it would require subsidy. And what that means is that Treasury has to provide some amount of capital to CDFIs, but it never provides enough. It's never enough. It's competitive. And so despite the fact there's 1,500 CDFIs or so in the country, they don't all get backing from the Treasury. And so that means that there's this mad dash scramble for capital. And many CDFIs are not depositories. They have to borrow money to lend money. How they're able to lend it is highly dependent on how much that capital costs them. And then they're stuck. They have a bunch of loans on their balance sheet that they can't offload because there's no secondary market structure. So that in particular is a missing piece that we're trying to solve for.
It's a really mysterious thing that the Treasury set up. And if I think of it correctly, CDFIs have a limit to their total asset size individually. Is that right?
Well, what they need to do, they have a series of things they're supposed to do. They have to make sure that 60% of their lending is to their target market. They can only select certain target markets. So, and the target markets are not gender-based. They're not self-identification based in terms of your sexual identification, though those are groups that experience like discrimination or what have you. They are based on other demographic categories. So Native, Black, Hispanic, low income. And your lending has to be to those groups. And then many CDFIs are sort of hyper local in their focus. So only in this city, or only in this municipality, or only in this state. And that means that it's kind of it's inefficient. It's meant to be close to community, but that makes it inefficient. And that means that whatever the needs are on the ground, the capital has to go to meet that, but it's never enough capital.
It's interesting. I one of my mentors before I took the affordable housing role I had at Fannie Mae, Karen Plata, led our single family business. At one point, she told me all of affordable housing is local. Everything's local. You try to do national stuff, it just doesn't work. You got to be on the ground. That really, really hit me. And then I went and spent 7 years trying to do national programs because it's just so hard to get local. But at the same time, the challenge that you're highlighting, which is you've got 1,500 organizations, I think huge spike in the number of organizations recently. But because they're hyper local, it's hard for them to get liquidity, and it's hard for capital providers to distribute it. And in some ways, you're creating intermediaries as a necessity to get to a local place. And those intermediaries, they add cost. At some point, they have to add liquidity. And I think that's kind of where your head's at.
And that's exactly right. And I mean, the other thing that is, it's a friction point and it's problematic about this kind of structure is that all of those sort of small organizations, they need the same kinds of things from a back office perspective operationally. And it's incredibly expensive to make sure that 1,500 organizations have like a fully functioning Salesforce instance and have highly skilled CFOs. I mean, that is exactly not what it doesn't exist.
Yeah.
And it means that they function in a way that it's not optimal for what is needed to be able to accomplish the work.
Sometimes you want to go where everybody knows your name, right? You want that local feel, but then you need the scale and the infrastructure and the liquidity that a national platform and that infrastructure brings. So scale drives down the cost, but you still want to be able to deliver the everybody knows your name feeling.
That's right. I guess let's pivot to the last and always exciting part of our conversation, which is what does all this mean for the innovators out there, for lenders and others? Before we drill into that, we're going to get a quick word in from our sponsor, and then we'll jump back in. This episode is brought to you by Bilt Rewards. Bilt is a rewards program, just like an airline program, that is centered around your home and neighborhood. But instead of earning miles for flying, Bilt rewards you for paying rent, no matter how you pay. As a member, you can earn points at over 20,000 local restaurants, local merchants, and those points are now the most valuable rewards currency. You can use it to book travel, on Amazon, or even towards a down payment.
Bilt is revolutionizing housing. If you want to learn more, email John at lawless@biltrewards.com. All right, welcome back. So when we think about prosperity now and we talk about what's really going on, John just teed us up for what's next. And you unveiled Prosperity Next. It's perfect. So tell us a little bit more about that programming and what you can deliver on.
Yeah, I mean, so we have, the advantage of expertise on our team that is both housing, small business, AI, sort of all of this kind of full scope experience. And we've partnered with Change Machine and Creditoo to be able to develop Prosperity Next to solve some of those ecosystem issues that we were describing. So the intention is really to create a platform that is end to end, that solves but from the origination point all the way through the secondary market process of actually acquiring portfolio and then selling that portfolio off either to banks for their CRA credit or potentially to securitizing that as an investable asset so that CDFIs can be recapitalized. That structure exists in housing. It's the entire reason why the housing industry is liquid. That's the purpose of the GSEs, Fannie Mae and Freddie Mac. And with that system in place for small business, there would be a whole lot more liquidity, certainly for CDFIs.
I mean, that's incredible. And Marisa, I'm so glad that you're joining this organization, kind of breathing fresh life into it, especially with the technology we have, the capital markets technology that we have. Bringing liquidity is such a great way to support these organizations, and I think going to be a way more cost-effective thing. Why build 1,500 instances of something when you can build one and get scale? Can you talk a little bit about, you mentioned small business lending specifically. When a mortgage gets made, it gets sold to Fannie Mae, they securitize, or gets sold anyway, it gets securitized by Fannie Mae, guaranteed by Fannie Mae, goes out in the capital markets. What happens to small business loans today? What's the size and scope of that industry?
I mean, it sort of depends very greatly. So if you're talking about like small business loans that come through a bank, it's like $2 million and above. So CDFIs serve the industry that's below that. And for the most part, many CDFIs that do small business lending are loan funds. And that means they function very similar to non-bank mortgage lenders, but with an impediment. So they don't have access to warehouse lines of credit, but they borrow money that is typically like sort of below market from different kinds of banks for CRA credit. And then they make loans, and then they hold those loans on portfolio. And then they, over time, become impaired because they're over leveraged. And then they just sit there with those loans. And in the absence of a proper solution to be able to buy that portfolio, they just have a lot of loans on their balance sheet. And because there's no consistency in terms of underwriting standards or credit box requirements, it makes it really hard for lenders that might want to acquire that portfolio for their own CRA credit to actually do that, because they don't know what they're looking at. They're not sure what the risk is. They don't have any kind of reasonable sense of understanding of what actually they're buying.
So these loans can go to nail salons, bakeries, hairdressers, all of these types of small businesses that we are so familiar with down the street from where we live are these types of loans, but there's not really a sense of whether or not one's riskier than the other, should be viewed differently, priced differently. Right now, it's just one size fits all local underwriting standards.
It's a very bespoke model that CDFIs have. Some of them do very character-based lending where there might be like letters from people that know you that attest to your credibility. Some CDFIs don't check your credit score and include that credit score as part of their qualification. It's an incredibly bespoke process that is based on the intention of making capital available, but it varies greatly from organization to organization. So just to draw a parallel in the housing industry, if every single lender had a different way of underwriting, it would not be possible to actually have any liquidity in the housing industry, and there would be no mortgages made.
It wouldn't work. The idea that we have 400,000 new businesses coming online every month, that is an incredible task for any network, any infrastructure to try to handle. And so now you can actually start to offer that risk, which we know people want to take because this is the new American dream. So there are investors out there saying, I want to be a part of this. I want to be a part of the ownership culture. They just don't have an access, and now they do.
That's right.
And I think you mentioned earlier today when we were looking at the data, 400,000 a month of new business applications is more than mortgage.
That's more than houses.
Which is incredible.
More than listed houses.
So I want to kind of connect two dots here for the housing audience a little bit. So when you think about mortgage underwriting, at Fannie Mae, we had a flag, self-employed or not, right? All treated the same. Of course, income underwriting is very tricky. It's done in sort of a very generic way. Is what you're doing in the small business world potentially going to have a ripple effect through the mortgage world where your insights and ability to understand and assess the local small business could inform a mortgage lender?
God, that's a really interesting question. I mean, maybe, because it's a different asset class. I mean, and it's not really being managed like an asset. I mean, most banks get their CRA credit for small business through credit card lending, and it's not a good equivalent.
Right.
So I do think that there could be some sort of downstream impact. I guess I would have to sort of think about what that would be.
Yeah, I mean, one of the best things for those entrepreneurs that were going to receive the services and receive the funding we're talking about is there's now a data trail. There's now a documented trail of this is what my business is worth. This is what I've done. That track record is really what underwriters rely on when they're saying, let's give that person a home ownership opportunity. That data ecosystem is going to be really valuable.
Yeah, I mean, to do something a little dangerous here and just throw out an idea that has popped in my head. My understanding is a lot of small businesses are often started with taking equity out of homes. And so there's sort of a form of cash out refi where if the cash is being used to buy a boat or to, put a gazebo in the backyard, it's a very different proposition than taking cash out to build a business. Because in some ways, if you're building a business that's low risk, good revenue potential, you're de-risking the mortgage client, even though they're taking cash out. And we maybe shouldn't be charging up for taking cash out in that sort of instance. It's
that certainly for those that own a home that can leverage their home equity in that way. And, back to credit cards, it is also credit cards. And there is a fair amount of personal credit card debt that's associated with starting up a business. And so like in the credit card industry, I mean, I wonder whether debt financing that is intentionally for a business ought to be reimagined, because there could be more security associated with a business-related credit card startup expense versus me buying a bunch of shoes or purses.
I love it. The risk profile changes and the economic outcomes of the lending change as well, because you're lending money that has downstream effects, second, third, fourth layer level effects. So you're getting more for your money.
Yeah, you absolutely are.
It's certainly an interesting, so it really ties it back to housing in a strong way. Let me talk about something else that we heard a lot about at the conference. We talked a little bit about here, sort of, fractionalizing, tokenizing different asset classes as a way to make the entryway a little bit easier. I was actually kind of surprised to hear that on a panel. I was like, wow, fractional tokenizing on a panel that you don't expect to hear that at affordable conferences. Can you talk a little bit about that sort of category of entryways into ownership?
Well, interestingly, I think that the reason that it's catching on is probably not because of the economic reason. It's because of the community desire to live in some sort of collective circumstance, because there's this like increasing amount of loneliness that's experienced in the US by living in a very solitary way. And so like the way that people want to live is sort of bumping up against this like systemic need to have a model that allows us to live in a way that's collective, because that really seems like it's catching on for that purpose. But increasingly, I mean, there is an interest from millennials to live in a fractional way, to be able to have like half a dozen people own a property together because they want to live together or because they want to invest together and like have that as an Airbnb that is a source of income.
Well, we're compelled to share everything about ourselves all the time. And so now we want to share assets as well. It's like,
you want to get something off your chest?
We need to share. Isn't that what Instagram's for? That's what I've been doing, John.
Yeah, I love it. Even things like Robinhood and things like that. I mean, I really thought of that as people gambling money. Anyway, though it's had huge success, and like that idea that you can access investing in a smaller way really opens the door for people that don't have a huge amount of money to invest. I think the stock ownership numbers are just shockingly disparate, but that really has the potential to change that.
Yeah, I mean, there's also like in the way of startups, there's a platform called Roots that allows you to invest in housing in this kind of like fractional way as well. And you don't have to live in it. You can, but you don't have to.
All great stuff. I want to ask one last question as we sort of wrap up. Our listeners are across the housing industry. Some might be at big lenders, some might be at small startups. What's the way that you would think that they should be getting involved in what Prosperity Now is doing, especially now that you're there and really steering it in a totally different, radical direction? What's your thought on how people can get involved?
For sure, check us out on our website. I think that's like one great way. We have an annual conference. I think getting together in person, especially now that there's no pandemic happening, is an incredible way to be able to get together. And then in community, I mean, we exist across the country and we have network across the country. So wherever you are, there are some of us. And we have a large and active membership network that is like yearning to be able to bring more people and to get them involved.
Thank you so much for joining us. This is inspirational. The work you're doing is incredible. We were humbled and grateful to be able to spend that time at your event. And I know everybody who's listening will want to be there next year.
And just to note, this episode was fueled by a bottled cocktail Negroni that we will now toast with to congratulate you, Marisa, on an amazing conference. We'd love to hear from you. Send us an email at podcast@thehousinginsiders.com. And if you like what you hear, how about leaving us a review?
And if you didn't like what you hear, forget we ever asked.